Welcome, everybody. Sorry, we're a little late getting started. Had a little bit of technical difficulty on my end here. We're going to just let people into the waiting room, and then we'll begin the talk in about 1 minute. While people are coming into the waiting room, I just want to remind you that each person attending has the opportunity to get continuing education credits, but you have to be on your own screen and registered yourself. If you're sitting in a group of people, only the person registered can get the credit. So if you are in a group and you want to get continuing education credits, I encourage you to go and register for the seminar. You'll be able to jump on right away, and then you'll be able to get your continuing education credits. I also want to remind everybody that this is being recorded.
Yeah, I'm going to hook this up so you won't hear me.
And we're going to mute everybody. If you have questions during the presentation, please send them to me using the chat function at the bottom of the screen. We'll answer questions at the end of the program, time permitting.
And this goes how long, Steve?
Until 1 o'clock.
Okay, and so you want me to, I think, like leave about
a few minutes.
Okay.
Yeah, if you can.
Okay.
Okay.
Steve, would you give me like when it is 12:30?
Of course.
Okay, please. Because I'm gonna, no matter where I am, I want to switch topics.
Sure. Okay. I'm just looking at, we had well over 100 people registered. So I'm just looking to see how many people we have coming in, give people another minute to get into the room, and then we'll begin.
Steve, just letting you know, I'm going to do a force mute on everybody. So you and Cynthia will need to unmute yourselves in a moment.
Okay, thank you. After 2 years of this, you think I'd have it all set and figured out by now, but I still don't. So. All right, I'm going to begin. So good afternoon, everybody. I want to thank you for joining us today for the second in our speaker series this year with Cindy Brittain of Karlin and Peebles, who's on the screen here. I only recently met Cindy, was very impressed with her. We had a lovely chat, and I know you're going to learn a lot from her presentation today. It's a very robust presentation. Her presentation and her bio were sent to you earlier today in an email. So if you haven't received it, please go to your email. You should have received the presentation from us. I want to welcome my regular attendees. And if you're new to this series, I want to extend a special welcome to you and hope you'll reach out to me or my colleagues and introduce yourself to us. We'd love to get to know you better. I also want to acknowledge my colleagues with us today in the room, Marvin Schottland, Dan Rothblatt. Someone just changed my video. Natella Roisman, Heather Baroff, Ellen Rosen, and Karen Friedman. And I want to give a special welcome to the newest member of our staff, Robert Avery, who's new to our team as Vice President of Finance. I hope you'll have a chance to meet him one day. I also want to recognize the members of our Board of Trustees and Board of Advisors that are joining us today. This coming Monday is Memorial Day, originally called Decoration Day. It began just after the Civil War as communities came together and used the onset of spring as a chance to visit graves and plant flowers around those that lost their lives in battle. In the Jewish calendar, we mark the end of the reading of Leviticus this week, in which the Israelites are transitioning from slaves in the desert and entering a wilderness. Before they can come out the other side, a land flowing with milk and honey, as it said, they have to transition into a community. Rabbi Jonathan Sachs calls these next readings the politics of responsibility. And Rabbi Ben Spratt writes about this, that at this time, the Israelites are, quote, given a vision of possible paths forward and offered a worldview where they will rise or sink together. That each person is now tethered to the next in fate and behavior. And John Shar, describing the faith of Abraham Lincoln, thinking about the Civil War, said, we're a nation formed by dedication to a set of principles and by an exchange of promises to uphold and advance certain commitments to ourselves. If we fail in our promises to each other, then we lose everything. Thinking about what's going on with COVID and so many tragedies in the world, you may have clients who feel disconnected from the community, who feel that they don't know how to make a difference. or children of clients who feel disconnected from their parents and their values. At the Jewish Community Foundation, we work with individuals, their families, their advisors, and others to strengthen families and our collective community through giving. Giving is a powerful way to address problems, to build cohesion in a community, in a family, and to ensure that no one has to live separately, abandoned, without dignity in their time of need. If we can help you and your clients with these issues, please be in touch with us. We've had remarkable success working with families and their kids and their grandkids, talking about their family values and how to build a community together. It's kind of like running a family business in a way, and it can be really powerful. So I hope you'll be in touch with us about this if this is something you're interested in. I'm going to turn the program over to Cindy, but before I do, I just want to thank her on behalf of the foundation for taking time from her schedule to prepare for this. It's a very robust presentation. I know it took a lot of time, and I can't thank you enough for doing it, Cindy. During the program, as a reminder, please send the questions to me using the chat button. We'll do our best to get to all the questions at the end of the presentation. With that, I'm going to turn the program over to Cindy, who will share her screen and get started.
I did it. And I think that
Wonderful.
Oh, there we go. Okay. So hello, everybody, and thank you for the opportunity to speak on cross-border planning. I love this topic, and it makes up about 80% of what I do in terms of estate planning. Cross-border planning is what I've been doing for over 30 years. So I hope you enjoy this presentation. It's different than I've done before, so I may have to refer to my notes, but what I have done is I've tried to build in some basic principles in planning, as well as some sophisticated planning, and I hope you find it helpful. I've also put in some points for financial planners, because I know that we have a diverse group of practitioners, as well as practitioner level and cross-border planning. You can use these slides, and if you have any questions, you're always welcome to call me. I love talking about this stuff. So I want to begin with a story, and it's a true story. It's about me. So I was living in Santa Barbara, and in 2008, my husband and I, my son, we were going to move to London because I wanted to immerse in cross-border planning. So I left my practice in Santa Barbara, and I moved to London. Now, when I got to London, they had me fill out a questionnaire so I could get my dependency visas for my husband and son. Now, like most of us here in California, we have a house. We may have some investment accounts, but in any event, we all are pretty used to using the California Revocable Trust with husband and wife as trustee. So I'm in the UK. I'm filling out my dependency visa for my husband and child. And on it, it says, list all your assets and their values, as well as how they're held. So of course I'm doing that. And I'm like, oh, in the Cindy and Don Brittain Revocable Trust. And little did I know that by being a trustee of a revocable trust in the UK, I had now imported all of our assets into the UK for UK income and gains tax purposes. Well, my husband had a startup, and it was sold to Autodesk. So there was some startup stock, and now some Autodesk stock with a very low basis. And I thought, holy moly, I don't want to pay UK rates for income and gains. So I told everybody, well, I'm going to revoke the trust. And they said, well, if you revoke the trust, you're going to trigger all the capital gains. I said, well, I will resign. And they said, you will trigger all the capital gains. And I said, well, I'll just leave and start over. And they said, you will trigger all the capital gains. Well, without a sale, but I would trigger all the capital gains. Well, that was very important because we were going to be in London for two years, and then in Hong Kong for 2 years. So it was inevitable that we were going to trip this horrible thing that I had done. Now, the whole reason to do this move was to make these mistakes on my own for myself. And holy moly, I remember that one. But ladies, you may appreciate this. I usually give my husband unilateral authority over nothing. But in this instance, because we were really trying to get ourselves over to the UK, I drafted our trust and I gave us each complete unilateral authority to revoke the trust as to separate and community property. That's not how we do it. Normally, we all know that we usually say, I can revoke as to separate property, but we both have to revoke as to community property or amend as to community property. But in this instance, I gave us each unilateral authority. And I'd never done that before, but thankfully, my husband was able to revoke the trust in California before coming over, and that saved us. The moral of that story is that in cross-border planning, each articulated movement will more than likely have a tax implication. That our move triggered tax, it should not necessarily be surprising because we overtly did something. But what if there was a cross-border rule that you didn't even know about that affected your planning here in the US? There's a phantom nexus of some sort lurking in our domestic planning that was going to create a harsh tax implication penalty on what we're doing here. And we do not perceive that nexus because it's a phantom nexus, but they've created a law in another country that has reached in and put a layer of compliance on what we're doing here as domestic planners. This presentation, we are going to look at strategies in cross-border planning, but we are going to look at compliance, some of those things that can lurk in our planning here and that we need to be mindful of, not necessarily as overtly as one of your clients saying they're going to move to the UK for the time being and they need to fill out a dependency visa, but short of that overt action, the things that will trigger some type of implication that we should be aware of. Now, this is what we normally see when people start a presentation on cross-border planning, the globalization of people. And that's old news. We know that people are coming to the US. And just so you know, these are the 4 food groups that we are going to see. US-based children. So foreign parents want to provide for US-based beneficiaries, pre-immigration planning, direct investments, and cross-border marriages. These are the big 4 food groups that almost everything is going to fall into. And here I just wanted to show, this is the 2019 Census Bureau, that you can see that California is still well ahead of other states in getting immigrants, poor to the extremely wealthy. Los Angeles actually leads the charge in immigration. It has become even, I think, the global lead in in immigration for globally. This chart I wanted to give to you because this is what I have heard on why people are moving to the US. They have NRAs, non-resident aliens have unique needs. And I don't need to go through these because I think they're pretty self-explanatory. But the springboard for this talk from the planning perspective is that wealth is coming to the US predominantly for these 3 issues. Ease of creating wealth, and that cannot be emphasized enough. The ease at creating wealth here and being an entrepreneur is phenomenal, and something that I hear from my clients is the reason they moved here, and they've become very successful here. A lot of the startups where we're using 1202 stock, for example, that's a unique to the US, and a great planning tool for people who are starting a startup is the use of 1202 stock to avoid capital gains if you have a qualified small business. The other one is our privacy laws. Now, I want to spend a little bit of time on that. Our privacy laws are also unique. Back in 2008, the US said that they created FATCA. And FATCA essentially was the US government telling, look, if you have US clients in your financial institution, and we come to you and we say, give us all US people who have or have had an account with you for the last 5 years that had $1 million or more, give that to us. And all these financial institutions had to build that infrastructure into the bank or into their financial institution. Those who did not wish to do it, they would politely say, you can't play in our sandbox. You can't trade on our stock exchange. And that was a good enough incentive that, of course, everybody did it. And now FATCA, where all different countries have to give to the US information about US account holders, that infrastructure is built. So all of these countries, now over 100 of them, have said, well, we already have the infrastructure built. Let's all go into the common reporting standard, and annually we will give each other tax and financial information annually automatically. So you will have Cayman giving to China. You will have Singapore giving to Italy. All of these countries who are CRS participants now automatically completely disclose the tax and financial information of people who are in their country, investing, creating entities, there's a whole world of rules regarding CRS that we're not going to get into. But suffice to say that it is a great sharing of information. And the US said, we're not going to participate. We're not part of that. So what happened is we can get information, but we don't have to share information. Now, we do have mutual exchange agreements, mutual information exchange agreements, but they're not tapped that often. And usually they're tapped in a very surgical way, that they will go to a bank with a very specific request. But in general, CRS is scary to a lot of people for personal safety reasons, just the desire to be financially private. And why not? Why can't our our financial dealings be private? And the US, a lot of people come and access our trusts because they want that privacy. And the trust, of course, we're going to get into to wrap assets so they're not subject to US estate tax. But the other thing is the preferred income regime. The US has a preferred income regime that is politically driven. Congress had this incentive because we want people to come and invest in our companies, that if I sell Microsoft stock, I pay capital gain. But if my colleague, my foreign national colleague in Hong Kong sells Microsoft, she doesn't pay capital gains. Same thing with certain bond interest, capital gains and bond interest and other types of interest. They're not subject to tax here in the US, and it's capital gains on stock. There's a completely different rule related to real estate, and that's the Foreign Investment in Real Property Tax Act, FIRPTA. And capital gains are required to be paid on the sale of real estate. But capital gains, interest. So a bank, let me just say this. During this process, during this talk, I'm going to be wearing two hats. I'm going to be wearing the international attorney hat. And based on my work when I was at Northern Trust, I was the director of inbound wealth advisory. I'm going to be wearing a fiduciary hat because the relationship between attorneys and the financial institutions, that has to work in sync, because we can create all these amazing structures, but if you don't have someone who's going to administer it, it's worthless to the client. It can't be clunky, and it has to be something that can be easily vetted. So we're going to talk about that as we're going through, and you'll see me exchange hats, but it's because I do have the internal experience of a financial institution. Now, we talked about CRS, but I just raised this so you know that when we get to the compliance aspect of this talk, because I said we're going to be doing something different. We've talked about globalization of people in many other presentations that you've seen. But the trend is the globalization of tax laws that now impact us here that we need to know about. This is the new paradigm. Essentially, other countries were tired of attorneys, CPAs not regulating themselves in terms of their planning. And they grew very frustrated that we could undermine the laws set up for transparency. We don't value that. We want our privacy here in the US, but we were undermining the rules and regulations in the EU, for example, that really stress transparency. So those rules now are coming in and placing themselves on our platform, and we have to be aware of them. We're going to talk about the foreign registration of a US trust, when that would apply, and it may be very non-intuitive. Like, for example, me moving to the to the UK as the trustee of a revocable trust, something that is nothing, it's a disregarded for our purposes, only for probate. So that was news to me. And then foreign criminal statutes that apply to us. This is that kind of phantom nexus that I want to get into. And something a little bit more upbeat, the foreign succession regulations when we are doing planning for assets in the EU. You'll like that. And I think that is something that I would commend you to learn more about. So this is just some fundamentals. I'm not going to go through this list except for number 4, 9, and 10. But behind these in the appendix, I have a much longer discussion of definitions. But I want us to be interested in number 4, because number 4 we're going to work with a lot in this presentation is the foreign grantor trust. And you guys know that when there's a grantor trust versus a non-grantor trust, the grantor trust, the grantor is responsible for the tax. In the non-grantor trust, the trust is responsible for the tax. So when you have this foreign grantor, your foreign person is the grantor, is the person responsible for the tax. And when you have a foreign person owning through this trust assets, you know that they're going to get the preferred income tax regime. So I want that to start layering that this foreign grantor trust structure is very interesting. And it provides us with the Cadillac, the Onassis trust, if you will, of cross-border planning for foreign people, planning for their US-based beneficiaries. Now, the other thing about this is that since the Tax Cut and Jobs Act, since 2017, there have been changes that I'm going to try to move this thing out of the way. Okay. There are changes to the definition of the controlled foreign corporation. I'm not going to go to the definition, but there's a longer definition of the CFC rules and the CFC definition. But also under the 2017 Act, we got this new animal, this 10% foreign-owned company. Now, Cindy, why are you bringing up controlled foreign corporations and a 10% foreign-owned company in a cross-border estate planning matter? Well, I want you to see, because these are going to be very important for us in representing the whole of the family when we do cross-border planning. I have this as a little checklist. A lot of this can be for the financial planners. When someone is getting ready to come over, they may wish to accelerate some of their income, income such as compensation, pension plans, stock options. You might want to trigger those and get them taxable in your country versus the US. Of course, we're always going to work with counsel in the other country to make sure that we're doing the best thing for the client. But maybe electing out of installment sale treatment and cleaning up the passive foreign investment companies. Here's just a little checklist for all of you to consider. I often forget and just make sure I go through this. I have several checklists that I go through, but this is just a handy dandy one that I tidied up for you. Now let's start with some core planning. This is a type of plan that we do every day. And you guys do this when you do gift trusts for US people. You do this when you're doing spousal lifetime access trust, the SLATs, for non-reciprocal trust for spouses. But you can do this too for foreign people because they're getting ready to come into the US, and you can do gift trust to kids, and you can do gift trust to each other because they're getting ready to come in, and you want to wrap their assets before they get here in these types of vehicles to make sure they're not subject to US estate tax. So let's see what this looks like. Yeah, there. All right. So foreign mom and dad in Hong Kong.
Cindy, you asked for a 12:30 reminder. It's just after 12:30.
Okay. So mom and dad do not want US estate tax on what they give to their child. They do not want US gift tax. They don't want US estate tax. They don't want US gift tax. They never want to trigger estate tax, but they don't want to be super complicated. So the parents transfer funds to the domestic trust, and this can be set up in jurisdictions that don't have a state income tax: Wyoming, Nevada, South Dakota, Delaware. Now, just so you know that I want to talk about gift tax right now, because in general, when the parents give assets to this trust, it's not going to be subject to gift tax as long as it's a transfer of a foreign asset, like from a foreign bank account to a US bank account. If they have a US bank account in their own name, they need to be careful, because that transfer from a domestic bank account to this dynasty trust could be considered a gift. So you might want to consider T-bills, because transfers of stock and T-bills, that's an intangible, and transfers of intangibles to this trust will not be subject to US gift tax. The transfer of cash from a domestic account in mom and dad's name to the trust would likely be subject to US gift tax. And so this technique should shield future generations from estate tax. And I use this a lot when I'm going to have US real estate, because US real estate is going to be subject to income tax, and I don't want to worry about the Foreign Investment in Real Property Tax Act, FIRPTA. So we've gone through the benefits of using this. So now let's go to core planning 2. Wow. I am hoping that I'm going to get to my compliance, because my compliance is super fun. So here is core planning option 2. And we're going to live in this a while, because mom and dad do not want US estate tax on what they give to their kids. They don't want gift tax on what they give to their kids. They don't ever want to trigger US estate tax, and they don't want to pay US income tax on what they give to their kids. And when they die, they want a basis step up. The basis step up is not available, of course, in the domestic trust. So they want it all plus more, and they can get it through this option. Now we're going to unpack this slowly. This is what we use every day to plan for foreign people who have U.S. beneficiaries and who have U.S. beneficiaries and possibly foreign beneficiaries. So we set up a foreign revocable trust, and we have these underlying companies. Now, why are we using this structure? Well, this foreign revocable trust is drafted in such a way that it's a dispositive vehicle. And here, when mom and dad die, just like with our California trust, it's going to tip to an irrevocable trust, and more likely with U.S. beneficiaries, a domestic trust. And we're going to have all that GST dynastic play, where let's say there's 100 million in here. For the life of this trust and the perpetuity period of this trust, we're never going to have estate tax. And so when it toggles, when mom and dad die, it of course will have income tax potentially, but this is our dispositive vehicle with U.S. beneficiaries and possibly foreign beneficiaries. Now, this is a revocable trust, so it is a grantor trust, meaning mom and dad or whoever the grantor is the grantor. And if we were to invest in U.S. assets alone in this trust, because it's a grantor trust, those assets would not be out of foreign parent U.S. estate for U.S. estate tax purposes. So we have to put in foreign blockers. So we put in these foreign companies, and this is ABC U.S. Virgin Islands and ABC U.S. Virgin Islands to hold foreign assets and U.S. assets. And here's this company over here that we're going to talk about in just a little bit. But the issue for the foreign revocable trust with the estate tax blockers is mom and dad pass away. We check the box on this one. We'd make it go from a corporation to a partnership, and we can increase the taxable basis, meaning it's as if we bought it on that day. And when child sells any of these assets, they're not going to be subject to U.S. income tax. Now, these are state tax blockers that are going to hold U.S. assets, usually the investment account. And in these, we're going to have it with a practitioner who understands investing for an NRA. And it's not necessarily the NRA parent, it's now this foreign company, because the foreign company won't die. And so they're going to sell and buy back, sell and buy back. And they are going to continue to refresh basis, because we cannot check the box on the U.S. assets, or that will make them subject to U.S. estate tax. So now you say, Cindy, why are you using the U.S. Virgin Islands? Now, I put in the U.S. Virgin Islands because I use them. And I'm a bit nervous about them because I haven't seen anybody else use them. But if a foreign person owns the U.S. Virgin Islands, essentially the rule is if a U.S. VI company is owned 75% or more by a foreign person, it is a foreign person for income and estate tax. So I have these assets in this U.S. VI company. It serves as my estate tax blocker. But what else? Remember, we talked about the common reporting standard. Well, I don't want the common reporting standard. So if I go in a BVI company, Cayman, Guernsey, I'm likely going to trigger that. And the USVI is US for CRS purposes, so it's not subject to CRS. Interestingly, it is a US entity for SEC purposes, so you have to really dig in and understand how to invest in one of these companies. Now, this BVI company over here is an operating company. And so I'm going to go ahead and move through here because I think I'm going to run up against the time. But in drafting, we have this qualified revocable trust. This is really important because this qualified revocable trust gives me a great option. It gives me the option of when mom and dad die, I can elect foreign estate treatment, which buys me 2 more years to restructure if I need to. But when we're drafting, we have to decide, is it going to be a separate trust for U.S. beneficiaries or a pot trust? Because remember, we saw that BVI company over there that I said was an operating company. It may or may not be able to be divided. So that means that I may have U.S. beneficiaries who are owners of a foreign company, and U.S. beneficiaries, even if in a irrevocable domestic trust, they are deemed to be the shareholders. So I have to think, what are their tax implications as if they hold foreign corporate shares in their own hands? So what am I going to do? So new strategies from 2017, the specified 10% owned foreign corporation. So during that 2-year period, I may want to decontrol a foreign CFC if I can, because I don't want CFC treatment. But I might not be able to divide it up, but if I can, with this new 10% foreign owned corporation, we're creating 1050 companies. So a 1050 company is means any foreign corporation with respect where you have a domestic C corporation is a U.S. shareholder with respect to the corporation. So let me go to the slide. This might be a little bit. Okay. So I have a 1050 company, and I now have this designed, and it's a, if you have questions about how to design it, happy to share. But let's say I had 5% owned shareholders. I'm going to bump them up to 10% shareholders, because for shareholders owning 5% and not in this 1050 type of situation, I only put in my pocket 45% of this dividend from foreign code. Or if I bump myself up to 10% and I get this dividend, I get to keep 57%. And that's I kind of did the math here in a down and dirty way. But I think this is very helpful. I mean, this is a strategy I thought up. So if you guys know something I don't know, I would love to hear that. I know there are some very creative thinkers, but this is something I thought up. And if I make the foreign estate election, I may be able to do some restructuring to get this type of, to bump them up in ownership. The 962 is where you do have a CFC and you cannot restructure. So you need to interpose a corporation, because an interposed corporation getting dividends from a CFC, there are benefits. But some people don't want to, or may not be able to, have their shares owned by a corporation. They can't do that kind of restructuring, but they can make a 962 election, and that's done at the individual level. And this 962 election here is individual holding stock directly in a foreign company, a CFC. The effective tax rate is 71%. Here it is where you make the holding structure through a deemed corporation, you reduce it down to 51.9%. So this is something that I really find interesting, and something I saw at Northern, is that you really have to understand that trusts, for foreign trusts, should be managed in the currency of the beneficiary. They have done studies that have shown that if you are hedging with euro, the trustee exposes the U.S. beneficiary to the underlying volatility of the stock and the currency exchange. So that's something that really needs to be thought out with the financial planners. So let's go. Steve, how much longer do I have?
You have another, well, if we go to 1 o'clock and you don't have a hard stop for Q&A, we have another 15 minutes, otherwise 10,
Okay.
10, 12 minutes.
Okay. So, all right, I will be able to get through here. Okay. I'll just talk fast. I have this sign up here that says talk slowly, and so that's not going to work. So when we're in the cross-border context, you always have competing concepts. For example, a UK person comes to Santa Barbara, and this is a story, and they purchased a home in Hope Ranch 20 years ago. And before they come to me, about 5 years ago, they went to a planner who put it in a California revocable trust to avoid probate. It may or may not qualify as a bear trust, but a bear trust can potentially take you out of what I'm getting ready to say. But let's just put a pin in that, a bear trust, because there's a problem with a bear trust. So when you're a UK domiciled person and you buy your home here in Santa Barbara and you put it into the California Revocable Trust, you immediately trigger a 20% entry charge that's due to the UK, Her Majesty's Inland Revenue. That's a problem. And so in this case, this person had this asset in this California trust for many years and had triggered this and now was not compliant with UK tax law. So let's say that I pick up the phone and I call my friend Simon in the UK. Couple of things. We have the attorney-client privilege here. And we like that because clients can come and fall at our feet and we can clean them up. We can make them compliant. We can help them. But in many other countries, Hong Kong, the UK, attorneys are actually mandated reporters for certain non-compliance. Now, there are many, many, many exceptions, but just keep in mind that they don't enjoy the type of attorney-client privilege that we do here. So remember, we have this bear trust. We're going to get to something in just a moment that I think is extremely important, but I want to talk about this common reporting standard. The common reporting standard is a law in other countries, and we have to be careful not to circumvent laws in other countries, because when I'm setting up that U.S. Virgin Islands company, I have to have a real business purpose, and I do, because China has CFC rules, but they exempt out the US. So does my US VI company is exempted out of China's CFC rules? Those are things that we are always having to make sure that we're working with counsel in other countries, because we have competing concepts, and we have to make sure that we're not circumventing in an unethical or illegal way, but we have a real business purpose. And I do, in that scenario that I gave you, I have a real business purpose for using the USVI as a blocker for CFC purposes. But I want to talk about people who are trying to circumvent the CFC rules, the CRS rules, because of the micro erosion of CRS in this country. And let's look at the investment funds, because this is something that, although the United States has decided not to participate, US fund managers may have to report clients, advise clients about their potential CRS. They have to understand that there might be a CRS requirements for that actual fund. And when I'm advising on, fund managers, I have to make sure that they get the appropriate self-certification so that they're not running afoul of CRS. And there's confusion because people who are doing these funds, there's a difference on responsible party for CRS, FATCA, and SEC, CRS, and FATCA when we're talking about the responsible party and who's the party on whom we need to report. So those are very important and can get your fund manager in trouble and jeopardize the fund itself. And here's the confirm what CRS registration is required. But let's keep going here. And this is another macro erosion of CRS, where FinCEN, if someone buys a real estate through an entity that's worth more than $300,000, or they do it without financing, they have to report to FinCEN. So that all of my clients, they're getting reported to FinCEN. So hopefully they're compliant in their home countries. But globalization of enforcement can, these are the ones that I deal with every day. I deal with all of these every day. And the UK Criminal Finances Act is really wicked because it's so broadly worded. And it says an associated person, that's an employee, an agent, or a referral partner to whom I may be referring services out, or we may work so closely together that the line's blurred. And if they are doing something and I know about it and I fail to prevent the facilitation of tax evasion, then I can be in real trouble. Now, everyone is trying to avoid CRS, but CRS is a trigger for the UK Criminal Finances Act. Well, why does this apply to me? Well, relevance. US attorneys, CPAs, financial institutions worldwide who may have the slightest nexus, a gossamer thread of nexus. You go to the UK to do business development. You have a client. You know, we don't know what they're going to interpret as that gossamer thread, so we have to be careful. That's why I kind of emphasize CRS, and I emphasize by using the US Virgin Islands, because that seems like something that would be something we would want to do just as a matter of course, but maybe not, because it's not fair to the client and it's not fair to us. We have to walk that ethical line. This one I'll just do, this is the French trust registration, and the implications and the penalties. You can see the penalty is the hire of 20,000 euros or 12.5% of the total trust assets that you didn't declare. Now, let's see when this would apply. So I set up a gift trust for my son, and he goes to Europe for 6 months backpacking, and he stays in an Airbnb, and he decides he wants to stay in Paris for a while. He didn't register his trust. We probably wouldn't even think he needs to register his trust. But we've now run afoul of these penalties, and banks, any number of ways, like me applying for my husband and son's dependency visa. The most innocent thing that we may do can open up this can of worms. So we have to be very careful, because trust that we do not think would, and this is even for contingent beneficiaries. Look at this. The Bono Family Trust is a discretionary trust. Jenny, her children and grandchildren, and her siblings are kind of just thrown in for estate planning purposes in case something happens to Jenny and her kids, but they're first up. And but the remainder beneficiaries, contingent beneficiaries, because Jenny's great nephew goes to work in France for 7 months. He had to register that trust, and now he is subject to this penalty. They're subject to the penalty, even though he is not a someone who would even get a distribution, and he may not even know of this trust. So that's what's so amazing about this. How would they know? That's the quintessential sentence I get from everybody. Well, how are they going to know? Well, you never know how they're going to know, but we need to be aware of it as practitioners. The UK also has one, and then we get to this one. The EU's mandated disclosure of aggressive transactions. So this one is very, very broad, and it's where we have to disclose aggressive transactions in the EU. It applies to any transaction that seeks to minimize tax. Let's look at what that means. Specific hallmarks related to the nature of transactions, planning for the use of losses, conversion of income into benefits that are more favorable. And let me see if I can, I'm trying to find out, I'm trying to show you, I have it in here when it applies to you, but it's when you have any gossamer thread of nexus to the EU that you have this directive. So we need to be very careful of this. And there's a couple of really good CPAs who knows this and can tell you when you are or are not into it. But frustrating CRS is one of the ones that is has to be disclosed. Ugh. So just want to bring that to your attention. And this one is kind of a happy thing because this is an EU rule that says if I have a client here who's from the EU and they have assets in Switzerland, for example, normally they would be subject to the forced heirship rules. And because all the different countries in the EU had different rules and regulations, they said, okay, you can choose your habitual place of abode, and that might be California now, or you can choose where you were born. And for the person who wants to now give to his or her mistress, they can come to California and cut out all their children. So I wanted you to know about that. This has to be done carefully, not in your trust. It cannot be done in the trust. It has to be done in the will. So I think I'm going to stop there and take questions because we went through a lot. This was, I appreciate your patience and your letting me present today, but I'm ready for questions.
Cindy, I only have one question so far. I think people are trying to digest all of the material they're getting, including me. And this may be one that someone just has to reach out to you directly about. But when you were going through the time frames of the issues in Paris or France and the UK, the question is really about what are the minimums that would trigger that? Like, is it that they have a job for a month? Is it they travel for less than 6 months? What are the issues?
183 days.
Throughout Europe?
No, in France. This is
France, okay.
specific to France. So if you're here for 183 days, then or more, you're going to trigger this. But the one thing I would say is that, this can be triggered not only by time, but by what you're doing. Maybe you're now showing that you are a resident in France and you're there for less than. So that's why you have to seek French counsel on if you are a beneficiary or if you're setting up a trust for beneficiaries, because you have to remember this is for contingent and remainder beneficiaries too. I have one where there is a beneficiary, but mom is still the current beneficiary, and she didn't register her trust. Now she has a huge penalty.
This is a question about, let's say you have a child studying abroad who has like a side job, and the trust gets triggered by death of a parent. What do they do?
They have to register it, and there are people, of course, in France where when I was looking at this and working on this with my client, I was working with French counsel, and they were doing the registration. So they were putting all the assets. I mean, it's very transparent and not something that we as U.S. people feel comfortable with. Disclosing and showing all the assets in a trust, who are the different beneficiaries, when am I likely to take, even the letters of wishes have to be registered by the person, and these aren't even binding. So this is a very aggressive requirement.
I just had the two questions. I don't know if you want to go on for another couple minutes or.
Sure, I'm happy to talk. If people want me.
Is there maybe one or two more points you want to make before we wrap up? I just want to make sure that people you had a lot of information in here, so I don't know if you want to delve. Oh wait, here's one more. I'm sorry, one more question. How do you successfully explain to an IRS agent that the account in your client's name really belongs to the brother, and that the account in his cousin's name is really your client's?
that is not a unfamiliar question. It's not done so often in European countries, but definitely my Asian Pacific Rim companies. They have a lot of people who hold assets in other people's names under like a nominee arrangement. And so what we want to do for, out of protection is to ensure we have a nominee agreement in place. But ultimately, if it is a nominee situation, then we have non-compliance because we may have had a foreign bank account reporting requirement or an 8938 foreign financial asset reporting requirement. There's that question begets it opens a whole nother talk on just how to be compliant. And then if we have to be compliant, which program do we use? The delinquent document, Streamline, OVDP. And depending on how spicy the situation is, that's when we kind of know which path we're going to take.
One more question, and then I think we'll wrap up after this because I know people had a 1 o'clock time frame. And Cindy, before I do, I just want to thank you again for taking the time to present on behalf of the foundation. I really appreciate what you did.
Sure.
The last question is, do you have any updates on IRS failure to respond to reasonable cause statements for 3520 penalties?
I will say that I've gone to battle with 3520s and the reasonable cause statement. I have gone to battle, and I won. I had a $2 million penalty, and I literally had to. Every time they came back to me, I sent them back something else to consider. That's a great question. And so much turns on who your relationship is with at the IRS, who the representative is that you get, because you're going to get different treatment. It's not consistent, but I just continually kick it back. And so far it's worked.
All right. Thank you again, Cindy. I just want to remind everybody we have one more presentation before we take a break for the summer. Wednesday, June 8th at 12 o'clock, again on Zoom. This is estate planning for LGBTQ plus individuals, couples, and family with Paul LaMartina at Jeffrey Mangels, Butler, and Mitchell. And all of you should be getting an invitation from us shortly for a meet each other in person, have just like cocktails and some food at the Vending Museum in Culver City on July 12th. If you haven't been, I think it's a great museum, relatively new, and a chance just for us to see each other and do some networking in person. And we'll see you June 8th. I hope to see you all in July. And then we'll meet again starting in the fall. And Cynthia, thank you again for your presentation. I really appreciate it. If anyone wants to be in touch with Cindy, you got her information in the bio today. If you want to be in touch with us, our information is here. Up on the screen for you. And thank you all. And I look forward to seeing you again in a month.
Thank you.
Thank you, Cindy.